So what's going on in housing? This is the February 2022 market report. So the big things: inflation, interest rate, and lack of inventory out there. So there was a article put out, Investopedia. Real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as prices rise, so do property values. We're seeing this. As we've seen inflation over the last couple of years, you've seen inflation in house prices, and they usually do work together with that. So as inflation is in here, home prices have risen as well. Homeowners are shielded from mounting rental prices because their cost is fixed regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. When you lock into buying a home, lock into your 30-year fix, your 15-year fix, whatever it is, your mortgage payment is fixed. Your taxes will fluctuate. Obviously, repairs on the house will fluctuate compared to renting. Renting has gone through the roof over the last couple of years. Inflation has taken that. If you had a home prior to, your payment stayed the same. So it's a great thing when you look at housing versus inflation mechanisms. It's some of the things that you want to kind of see. Is a house a good investment? People say, is it a good time to buy? It still is a good time to buy. Even when rates ticking up, it's still a great hedge against inflation. Let's talk about rates. Rates are now over 4% for the most part. Some, banks and some investment properties are now 5%. I just heard from one of the big banks that they are now considering second homes as investment properties, which is what we saw back a few years ago. For a while, they were considered primary residence, or they weren't tacking on the investment interest rate, which is about 1% higher. So what happens with this? What does this mean? I was looking at an investment property with a client, and we did the numbers. An investment rate, it was going to be a 5% mortgage rate. You know what? They were losing about $200 a month on the property. And I said, well, if we looked at this 6 months ago, the cash flow would have been positive on it. That's the difference. So now they have to pay less to offset that interest rate increase, which then brings down value. So investors are going to be a little more cautious now that they have to pay these higher premiums for it on a monthly basis. Is that going to affect prices? It will probably level them out. Rents are going up as well for stuff like that, which will offset some of it, will offset it from going down. But definitely with the rise in interest rates, it is going to affect things. 10-year treasury yield is going up a lot, no doubt about it. That's what's tied into our interest rates. People are starting to get out of the stock market a little bit, and they are now going into bonds and pushing the 10-year treasury yield up, which means mortgage rates go up. The biggest factor, a lot of people, when they hear Fed funds rate, they think, well, the Feds are going to raise their rates. Yes, that does affect mortgage rates, but it doesn't directly correlate to it. The mortgage rates are written off the 10-year treasury note. So when you look at the correlation between mortgage rates and the 10-year treasury, they are, parallel, 100% all the way around. That's what they're tied to. So something to look at, something to see where the stock market goes. Stock market drops, people go to the bond market, 10-year treasury yield goes up. We'll probably see an increase in mortgage rates unless the Feds will go in and buy some of those mortgage-backed securities, which will keep rates a little bit lower. The biggest problem that we're facing today is low inventory. So we all thought we were going to see a big pop of inventory come January. It was projected that this January would be the busiest January, on record. We had COVID at the end of the year and the beginning of January. We had really cold weather in January. And I think that pushed a lot of people from putting their homes on the market. What does that mean? The demand is still there. There's actually more demand coming in now, even with the interest rates rising. We're seeing some of the bottom levels die off. I do think we're going to see a pop in the next few months as the weather breaks. There always is. Is it going to be a big balloon? Probably not, but we will see some more inventory coming on. When you look at the numbers from 2021 versus, you can't really look at 20, but you can look at 19. 21 had a lot of transactions. I think there was over 6 million transactions. There was definitely inventory out there. We had some left over from 2020, and we had people that were pushing, the numbers before the market kind of changes. Where are we going to see this year? If we see a little bit over 6 million in the U.S. homes sold, my guess we'll probably see 5.5, 5.25, something along those lines. Home solds, which is still, there's going to be a lot of inventory out there. So I know buyers get frustrated when there's not a lot of inventory. There still is inventory out there. Sellers, best thing to do is help prep your property. We go in, take a look, what can we stage, what can we declutter, should we paint the wall, get the landscaping together, different things like this that will help get more money. there still is, we hold an open house, there's going to be 10, 15 people coming to look, at least sometimes 30, depending on the property for the open house. The foreclosure moratorium for the most part in the U.S. is lifted, but it's going to take a long time to see those properties kind of cycle through the market. So, when we look at that shadow inventory that we had back when, the banks were taking properties back, or, big corporate America was buying homes, I don't think we see a lot of that. I think if we see it come on, it's going to be dripped. I think throughout the U.S., you guys have heard a lot of companies like BlackRock that buy properties and hold them as their asset classes. Are they going to put some of those on the market if they see the market kind of drop a little bit? Maybe. But we don't have a lot of that in our area. With New York real estate, number one, with the prices, with the bureaucracy to get a property sold, it's not as easy. It's not digitized. The big companies, that it takes longer to get rid of their assets, you're not seeing that as much here. So I think with the forbearance stuff, we'll see a little bit, but not a huge dramatic on that. One of the things that we're looking at is the mortgage credit availability. So there was a lot of mortgages that were available for people based on what they were getting, what their income was, what their credit score was back in 2019. We saw this drop in 2020 with the pandemic. The banks got a lot stricter because they didn't know what was going on. We've seen those things ease a lot. There's a lot of, it's called QM loans, where basically they are able to lend for people that don't show a lot of income. Let's say you own your own business, but you have write-offs, but you made $200,000 a year. You can do a stated loan, putting in there with a large amount of money down. You need a good credit score, but things are back. Reverse mortgages are hitting strong right now. You're seeing a lot more with low credit scores. Fannie and Freddie are kind of opening up the guidelines a little bit. So we are seeing a little bit more availability with credit, which will probably help us as interest rates go up. So overall, I still think we're in really good markets. People ask, well, what's the market going to do this year? I still think we're going to see some price appreciation. And I think instead of 10 offers on every house, I think we'll see 3, 4 offers on good houses, and houses that need work or that back the highway, they're still going to sell. You just aren't going to get those crazy numbers that you were seeing over the last couple of years. So I think really taking those things into account, really looking at the market, we want to see what the buyer demand is, where people are going in. Unless interest rates spike to 5% this year, which I really don't think they're going to. I think they'll be up a little bit higher, but not 5%. We're going to be in a strong market. We'll see a big pop come the spring, and that will help consumer confidence as everything goes. And hopefully one of these days, COVID will not be this dramatic thing, and it will kind of ease out, and the economy will keep rolling through. So if you have any questions, want to brainstorm, want to go over any ideas, feel free to reach out. You can click the links below, and we'll set up a time to chat.